Joining us at this hour, Joni Teves, long-awaited conversation. She's the precious metals strategist at UBS Investment Bank. Joining us this morning. Great having you, Joni. Let me start off by getting a sense from you. You're obviously bullish with regard to gold for calendar year 2026. What's driving the bullish call? Because central bank buying, has that at all tapered? I mean, that's what I've been reading up on, that maybe there's been some bit of selling, in fact. Is that at all playing out? What's your sense?
So, in terms of our outlook for gold, we really think the main driver for the rally that we've seen in the last few years is diversification. And our view is that this driver remains in place. So, whether it's official sector, institutional investors, as well as retail investors, the argument for diversifying portfolios into gold in this environment where there's a lot of macro uncertainty and geopolitical risk, this remains intact. Yes, with regards to central banks, there has been a slowdown in the pace of the purchases. There has been some selling from some central banks in the first quarter, but this is not entirely a surprise. We did expect that official sector purchases is likely to be a bit slower than it was last year in terms of volumes, but we think that this should still be sufficient to provide the support for the market to continue the uptrend.
This is Sajid here. Do you see this diversification to continue into 2026? Or, many of the central banks have reached an optimal mix of their reserves at this point in time?
So the diversification, I think, continues. I think there's a broadening kind of base in terms of participants within the official sector space as well, and it's really difficult to say, where central banks are trying to get to in terms of their gold reserves, whether it's they're targeting a certain tonnage or percentage of total reserves. Very few central banks are quite vocal about their strategy, so it's very difficult to assess that. But from a diversification standpoint, we do think that there's still room for many emerging market central banks to build gold reserves.
And how do you see China in this entire thing? Is China continues to be a net buyer in this market?
Yeah, so the latest data on China, the official sector has continued to be a buyer of gold, and we think that the fact that there has been consistent purchases each month suggests that the program is still in place. As far as consumers in China are concerned, we think onshore sentiment remains very strong. And that's likely to also continue, particularly in terms of physical investment in gold. Jewelry is a different story. The high prices of gold and also kind of the economic uncertainty, particularly with higher oil prices in this environment, might continue to weigh down on jewelry demand. But we think investor interest in gold remains strong.
How should one look at the fast evolving macro, right? Given West Asia and everything that's playing out over there. The 10-year bond yield has moved up 4.6%, now cooled off to 4.5, the US 10-year. What's the sense like with regard to the impact of that on gold?
So I think there has been sort of a stronger correlation between gold and real rates at the moment. And I think that's what has put some pressure on the gold price in the near term. The fact that higher oil prices and the impact of that on inflation expectations and therefore expectations on the Fed has led to higher real rates, a stronger dollar. And I think that has weighed down on the gold price. I think consolidation is probably going to continue in the near term, and we can't rule out further downside risks over the near term. But as we said, that diversification is likely to continue, and to the extent that higher oil prices and higher inflation could eventually lead to a drag on growth, I think that does create upside risks for gold in the medium to long term. If we're starting to worry about much slower growth than expected, and potentially, a more dovish response from the Fed in any scenario where growth is weaker.
Do you expect gold to rally again this year and hit a new high? And what's your target for gold?
So we have a 5,600 target for gold in 2026. We do think that we are towards the latter stages of the bull run. So we do expect prices to start to taper off into 2027. But as mentioned, I think that a lot depends on the situation in the Middle East and ultimately what happens to growth and inflation expectations. So I would say in the near term, the risks are to the downside, but medium to long term, the risks are actually skewed more to the upside.
Joni, with regard to silver, what do you make of the moves? How should one contextualize the move that we saw earlier this year? And how should one play silver? I mean, going forward, what's your sense?
So our silver view is very much tied to our gold view. So given we're expecting gold to continue to rally later this year, we think that silver can also rally on the back of that. And in fact, we expect silver to outperform on gold on the way up. The marginal risk for silver, though, is that given there is potential for growth to be weaker, that could impact silver's relative performance to gold. So whereas currently our base case is that silver outperforms gold significantly, perhaps to the same extent that we saw earlier this year, that's likely going to be more of a challenge in a scenario where there's a weaker growth backdrop.
And do you expect more volatility in silver compared to gold in terms of prices, given the fact that there's more speculation in silver?
So silver just generally tends to be a more volatile metal than gold. It usually outperforms gold on the way up and underperforms gold on the way down. And given the overall rise in volatility across the space, and even though that has sort of started to ease in recent months, I think we're still sitting at relatively higher volatility, compared to historical levels. And as long as we have this much uncertainty in the macro space, I think volatility across the precious metals prices is likely to remain high.
How do you look at flows into gold ETFs? Are they tapering off at this point in time, or it still continues to be net inflows?
ETF flows have been quite choppy and relatively muted in recent months. That is a general, that's been the general sense across positioning. So even looking at speculative positions in COMEX, positioning there has also been quite muted. And I think it reflects how a lot of market participants at this point in time are, don't really have a strong conviction and are struggling to trade the short term, given the level of uncertainty, given the choppy price action. So although I think the underlying sentiment remains positive towards gold over the medium to long term, I think there's little interest at the moment to really put positions in size.
Okay, the gold to silver ratio, medium to long term, would continue to be around 70 times, which is what has traditionally been the case over the last 100 years. Is that broadly the benchmark one uses when valuing silver largely?
So we don't really consider the gold silver ratio as sort of dictating a fundamental reason for where it should trade. I think the gold silver ratio is more of a useful tool to sort of gauge the relative performance of gold versus silver, and to sort of capture opportunities when one metal may have run up faster than the other. So in terms of our current expectations and price forecasts, we do think that there's room for the gold silver ratio to trend lower in favor of silver. as we expect prices to go up, we do think silver will outperform gold. But during, in the sense that once the market starts to correct and sort of in that tapering lower, that should mean also that the gold silver ratio starts to trend higher a bit as well.
If you can give us a sense of the structural shift which is now taking place in portfolios for last 12 to 18 months, now do you think now gold forms a part of that portfolio mix as compared to earlier, given that the kind of returns that gold has given is comparable to the equity returns for many markets?
So I think the structural shift in the gold market in terms of how market participants really view gold as an asset started in 2022. When basically the macro uncertainty just increased significantly, geopolitical risks increased significantly with the conflict between Russia and Ukraine. And I think that's when gold started becoming a more core part of investor portfolios. And it was also during this period where we saw a significant increase in official sector flows. I think it's really kind of the sanctioning of the Russian central bank. And then in the years after that, we had basically one increase in macro uncertainty after the other. And I think it's in this environment where there's a lot of macro risks, a lot of geopolitical risks, that gold has become much more a core part of investor portfolios.
Okay, Joni, thank you so much for coming in and speaking to us, giving us all of those views. Important from an asset allocation standpoint, of course, viewers, to kind of consider how gold is playing out, and hopefully you've got that perspective from the very best. Thanks so much for coming in and giving us that view. Let's quickly move on though.